Time now for our Muni moment, and a Muni market that is on pace to record consecutive full-year negative returns for the first time since the early 1980s. Joining us now to break it down is Chuck Peck. He is head of municipal products over at Wells Fargo. And we think about potentially back-to-back negative returns. How much of that can we blame on the Treasury bond market?
You know, I feel like in the context of the municipal space, it's really a question of supply and demand. Yields have reached the point that it makes sense to be in the market, and investors want yields that are higher than inflation. Otherwise, you're eroding your savings. And we've been in this prolonged low-rate environment that was great for issuers, but unrealistic and exacerbated by COVID. And the transformation was unfortunately painful because it happened so fast, but the pain trade is over. You know, I don't see additional spikes in rates given that inflation and growth is in check. And as you point out, we're 2 years back to back in a tough environment. And I think that 2023 in a lot of ways has been a continuation of a period of capital markets disruption that's not unique to the Muni market. Depressed IPO activity, for example, a lot of anxiety around the commercial real estate space with $1 trillion of securities that need to be refinanced over the next 3 years. In the context of munis, the federal government has been pouring cash into the space, which has depressed demand. So I think there are a lot of unique factors at play.
Well, take us into 2024. Does that supply-demand imbalance come more into alignment?
I think it does. I think we're likely to start off 2024 in a similar place to where we are now. But we should expect some level of recovery thanks to a couple of factors, recessionary fears that are forcing state fiscal officers to think about reserving cash and keeping dry powder. Pension underperformance, of course, which are forcing public entities to use pay-as-you-go resources to fund required contributions.
But I understand there's a need for some of that, but when you consider the higher costs for these municipalities on an interest rate basis here, how much does that affect supply?
I think it's a deterrent. But at the same time, the shape of the yield curve makes funding projects more cost-effective than before because you can reinvest your bond proceeds. Yeah. Same thing with refinancing transactions, which haven't been as popular lately because of the interest rate environment.
And this gets to a thing, too. I mean, I was looking kind of at, we have an index here at Bloomberg that kind of tracks the outlook for municipal issuance over the next 30 days. For most of the year, it's been pretty down, as I'm sure you know, but it's actually perked up recently here. It's not back above historical averages, but certainly the expectations have come that we are going to see a little bit more of a supply come through the pipelines pretty quickly.
Right, and I think that's because there's a growing sense that we're done with increasing interest rates and we're going to be in a stable environment for some period of time. What we're not seeing is refinancings coming back yet, and that's really what's holding supply down.
Is there a calendar effect to this at all? I know most municipalities are on a fiscal year calendar, but is there a calendar year effect at all to issuance?
Technicals are strong at the end of the year and the beginning of the new year, and there are some nuances in the market where investors will start harvesting tax losses between now and the end of the year to sort of clean their books and start fresh going into 2024.